Well, hello everybody, LA here. This is March 19th report, recording this on the evening of the 20th. Last week we had some indigestion after another move to the top side. Market comes back down after setting new highs. Gold up on the week, dollar as well. Still good gains on the small caps, some gains on the S&P, but into the red now on the NDX, and we've got some big losses in bonds. And bonds are still driving this story. So let's flip through some of the technicals here. Here's the bonds. Bonds have a swing point low. They break down. They try to retest and they regenerate lower. And if you look at it on a long-term basis, they've got two bullish retest regions that potentially are going to fail here on the monthly chart. Now, there could be a stick save. We should, looking at this up here, it looks like we should be able to get some sort of a bounce here pretty soon. And so we may get a stick save on this monthly, but the trend clearly is down at this point. If we look over at the dollar, right, it's levitating. It pushes back up, trying to get some sort of a little ABCD structure going to the top side. Looks like it actually completed it, doing a retest regen off this bearish breakdown. And assuming this gets rejected, which it should, then we'll have some more indigestion probably as a result of the bond and currency issues over time. But it doesn't have to happen immediately, especially if the bonds start to work their way lower. That should help the equities. Longer term, or at least some of the equities, right? Some have been feeding off that like financials. They'll probably get hit. And so you may see a rotation, for example, out of the financials into other things. Looking here at the equities, long term in general, equities are still bullish. Nothing's changed there. But let's kind of go through, and this is kind of a busy chart, but let's go through some of these, and let's take the NDX 100. This has been the weakest index for the past 2-3 months. And if we look at it, and I've got it on a weekly basis here, you got a swing point low that's right there. Tested it here, tested it on more volume. That's a negative, right? Then it tested again, more volume again, and then you get some sort of a little bounce here. But this is trying to set up sort of an ABCD structure to the downside, right? So in other words, we could draw it in like this with a bounce here and potentially a negative move back down into this area. So that's the negative piece of it. And again, we're looking at the weakest index. The bullish retest region zones down here, that was a test into it, came in on heavier volume, but it was the first test after more than 6 bars, and it should try and bounce and only test the top third, and that's what it's doing. And so all of that still looks like what it should look like. The problem is if it comes back again, because if it comes back again, right, the odds increase that instead of holding in the top third, which is basically what just happened, right? We had the top third here, got in there, tested into it, right? Second time around, you should test the bottom. Now, if you test the bottom, that itself becomes a problem, because a second test, if it brings us to the bottom, is that now, look at all these swing point lows that are down there. You got one just under it, another one a little bit farther down, and another one over here, and they're all grouped together, 3 of them. If you were to break these, then things get a lot more interesting to the downside. So you can see there's risk. There's risk in these markets. It always is. We just have to keep looking at it. Flip around. Go to the strongest, the small caps. Now I've got it on a monthly, and here on the monthly chart, you can see that the small caps have been this tremendous run to the upside, right? You had this big move off the bottom and then a continuation move, and this thing has done pretty much what you would want it to do. The problem is you're starting to get tails up here. You're getting these long tails. There's one here, there's another one on this one, and if we close down even farther this month, we've got about 7 days of trading left, you'd have 3 tails in a row after an extended run. That's kind of a dangerous spot. And if you take that top and you take back to where the retest regions would be, in other words, it would be normal to come back this far, that's a 25% loss if that were to happen. Why am I pointing this out? Well, I'm pointing it out because you have to know how much you can lose to try to help you understand how much you should bet. And if these markets are trying to decline potentially 25%, then you need to make certain that you're aware of that and have some sort of mitigation plan in case it happens. Now notice that at this point, this market's taken and moved 150% off the lows. And it's done that in a year. That's an amazing run, folks, right? Note the NDX did 200% off the lows, and now it's starting to try and correct, as we saw up here in the preceding chart, right? Starting to come back. But this was a 200% run off the lows. It did the same sort of thing the Russell did, made the first run that was probably equivalent to the Russell's, consolidated, and then made its final run. Will this do the same? I don't know, but should it consolidate? Yes, pretty soon it probably should. Here's the intermediate term on the Russell. Again, if we close under a particular level, in this case the swing point low around 2066, I would think that consolidation is definitely in effect. We're seeing increased pressure on sell downs. Again, the normal retrace here could take you back on a weekly, just like the monthly, to that 1666 area. Switching over to the S&P, the broadest, the one I watched the most. Volume on Friday last week. This spike up, a lot of it has to do with the quad witching. So you ended up basically even a doji after it pushed lower, after it pushed higher. But notice the retest region off this swing point high failed. That says that whatever was up, right, so the move that's been going on here, right, is probably done. It's probably sideways at best, potentially down. And so that tells us that more than likely, just like when it retested region here and failed on this bar, what did you do? You got consolidation. Well, you should expect consolidation again as a result of that. That would be the normal thing that would happen. If it were, the fact that it's coming into this swing point high here and it's the second test of it, that means it should test in the bottom third, which is down in this area. That means this area is the consolidation area. And so that's what I would expect. Intermediate term, if we look at the S&P, it could easily decline back into the swing point high, this swing point high as well. The particular decline, if it were to come back, should be in the top third here, so we would expect it to only trade the top third, which is kind of the bottom of that green that you see. Even though it's still trying to grind higher, you could easily get a 10% decline back to here from the current levels. And so if you look across all these indexes, you can see that there's risk of this coming back. But let's not get so tied up in the risk to not pay attention to what could actually still be out there in terms of reward. Here's ABCDs that are in effect right now on the weekly, 40, 45, and 41.90. So if this market does continue to grind, 40, 45 is the next attempt at the higher. I want to point out something else, a little bit off subject, but it's worth looking at, and that's the volatility signature. It looks like it's changing, or at least it may have changed. I've gone back here in time. These are on monthly charts. The range back in this time frame, and actually, unfortunately, I cut the time frame off, but I did, point out what time frame it was. This was 2004 through 2008. The range was about 10 to 18 back then. And so, it bounced around in that level until we had a significant correction. So all these little corrections just kept it in this range. If we move on to the next bull run, right, 2012 to 2015, again, 12 to 20. So up here we were doing about 10 to 18. Now we're at 12 to 20. If we go to the next one is 16 to 19, the range back then, 10 to 17, and then it bumped up a little bit around 12 to 21. And so if you omit these two areas where we saw the market sell down significantly, which was this spike, and again over here, this spike, you know, we were still doing the same sort of ranges, right? That 10 to 20 area, a little bit higher, 21. Now, here's where we are now in the latest bull run. So the last year of this bull run, what have we done? Well, it's a little different because now the range is in the 19 to 33 area. Significantly different than what we saw back here, and then all the ones prior to that. That tells me the expectations for this market is that we're going to see a lot more gyrations, right? Faster moves up and down. And so the signature of this looks like it's changed. It's something to be aware of. So in other words, you've got to compensate for volatility being faster and farther than it was before. And it's sitting at a higher level overall. What's the bottom line here? Last week, if you tuned in, we considered all the bullish sectors. We listed many of them. Essentially, the economic and growth, the common themes were economic growth cycle and inflation type stocks and safety and value type stocks. And you might even put the healthcare in here. There may be some rotation into it as well. On the fact side, the U.S. government and world governments in general, they're all doing the same thing, and that is they're deficit financing all this COVID for the last year. Equity markets at least partially reflect this economic boom that's probably going to hit as a result of that. And you see the forecast of, GDP from, 6% plus. And so these markets are reflecting that expectation. On the flip side, inflation is increasing, and that's pushing the bond market up. And that bond market is in direct conflict with these equity markets. And we're seeing that push and pull take place right now, where as bonds go up, the equities typically type to sell down, right? Now, what always happens with news is that when you get the news and you get some sort of a new range, like let's say bonds were trading up here and then all of a sudden they spike down and start trading at this level. Once they level out at this level, then the equities can pick back up again, right? It's the, ratchet down, accept it, get comfortable with it, and then until it goes to another lower level, right, where it makes a faster move. It's the faster moves that force these things to adjust. And so right now we're in one of those adjustment phases. I suspect it will end here at some point. The interpretation of all these facts, in my opinion, is that the Fed says this boom is going to be transitory. So even though the economy is going to take off, the Fed says, hey, don't worry about inflation. We're going to keep the pedal to the metal. We're not going to worry about it. We're not going to cut back on our QE. We're going to keep doing what we're doing because this is transitory. Well, the market says, hey, maybe it's not transitory. Maybe it's not temporary. Maybe it's going to continue and get worse, and that's when they start pushing rates higher. So what do? Well, just follow the price. Follow the action. Right now, it pays to be in stocks. They continue to grind their way up, and even though we're getting these setbacks, the trajectory, as we see in the charts, still is to the top side. And until that changes, right, you got to be in it. And so be in the ones that are benefiting from this. Those are ones that have inflation characteristics or have been rotated in as a result of safety value type assets. Let these things that have been leading us up really strong, like financial, energy, the small caps, let them come back in to buy, right? You're probably going to see these things that have done this straight up move start to consolidate, right? And you want to try and buy the consolidation near the lows on the consolidation for that next potential run up if it comes. But you don't want to be too early, so you have to try your best to be patient and let these things come back in, right? Buy them again. Assume there's more upside, right? This market just continues to find a way to go up. And until this changes, right? Until we don't see this, we have to respect it and we have to try and profit by it. As a backup, though, as we saw, there's a lot of potential risk out there. We saw that the VIX, the character of the VIX has changed, faster moves up and down. So you got to have a plan. You got to be able to mitigate somehow if this thing starts to chew away all your gains or take you into losses. You got to have stops, or you got to keep your portfolio size a little bit lower so that you can buy lower, to average. But you need some sort of a mitigation plan. In our trading plan, we're up about 3% on the year right now. The TLT that we were in got stopped out, unfortunately. I suspect it was just at the wrong time, of course. The market turbulence is likely to continue, and the focus shifts mostly from trying to enter right now to mostly managing the positions that we have on the table. Fundamentally, politically, the Fed didn't backtrack at all. Inflation expectations continue to rise. The jitters are clearly being felt. You see it in the bond market, although I think we're going to see a bounce there, and we'll see some more rotation in the equities as a result of that. And geopolitically, it is a friggin' mess everywhere I look. It's always a mess, but it's even worse of a mess now. You got protests all around the world this weekend, nations attacking each other, Saudi Arabia getting hit with drones. It's tense. It's tense everywhere, but when isn't it? I mean, it just always seems that way. Weekly prognostications. Last week we kind of hit the most likely scenario, about even now with that pick, across all those picks. Here's what I think the potentials lie. Best case, this thing just goes up and either hits the highs or makes some new ones, and maybe goes up and hits those targets, those ABCD targets around 40, 49, I think it was. Worst case, you probably go down and get into this meat of this area right in here. I think the most likely case is we get some more gyration, right? We get some consolidation type action going on in this market. And that's where we are this week, folks. Have yourself a safe one. Stay healthy, and I'll see you next time. Take care.